Hi, and welcome back to Channel 11. This is Ken Shinoda, your host today on Thursday, May 26th. Here I have Andrew Hsu, portfolio manager with me, co-portfolio manager on a couple of our funds. Thanks for coming in.
Yeah, and thanks for having me.
Of course. And here we're going to talk about the ABS market today.
Yeah, exciting.
Very exciting stuff. Andrew prepared some slides. Why don't we start off just what is the asset-backed market? Why should investors be looking at it as an opportunity?
Yeah, I mean, so the asset-backed market, I think it's really important to look at it now. It's always been here. I mean, it's been a market, established market for a long time, but the growth in the market has been substantial. And what we have on the screen right now shows just kind of the magnitude of this growth. And, a couple of things I would point out, not only has let's call it pre or during the great financial crisis, we had about $129 billion of issuance. We had close to $300 billion issuance in 2021, but it's more the makeup has changed, right? So you see this graphic that we circled here, the esoteric part of that market has gone from $3 billion to $100+ billion, and it's still growing even in 2022. So I do think this asset class is growing so much, it's offering a lot of investors opportunities they haven't seen before.
Because historically, back, actually one of the first securitizations ever done, I think, was a credit card receivable and an SPV. So the market used to be dominated by things like credit cards and auto loans and student loans, some of which didn't yield much because they were so short and so safe.
Yeah.
But there's been this big growth, like you said, in that esoteric space where you can kind of pick and choose the exposures that you want to get, right?
Definitely, and everything you said, I just switched the slide just because it kind of touched on some of the points that I do think is important. When you look back at the asset-backed market in its infancy, it was really a consumer market. There were auto loans, student loans, credit cards. In here, we highlight equipment securitization as well. So everything on this graphic that you're seeing on the screen right now, everything in that beige, I guess, dotted line, is really a legacy product. So that existed long ago in very well-established market. And oftentimes there's a term here. It's called flow product. And those sectors would be called flow product. They trade often. They're issued into the market on a regular basis in very substantial size as well. Now, all of these other areas that you're seeing on the screen, whether it's residential solar, whether it's consumer loans, home improvement, data, transport, all of those sectors are new. And that really kind of spawned off post-Great Financial Crisis. And what that has allowed kind of the market to do is really finance assets that have really never been financed in the securitized markets before, but also it has brought in new investors into the space that traditionally haven't really been involved in the ABS space. So the confluence of both those aspects have kind of increased the volume in this space a lot, but also increased a lot of the opportunities.
And so the issuers, if they weren't coming to the ABS market before, they were issuing in the corporate space, or how are they financing themselves?
They were issuing in the corporate space, or they were issuing within private markets, or oftentimes, look, it's interesting because your question is also why are they coming into this market, and then there's kind of two answers to that. One from the issuer standpoint, and then one from the standpoint from investors who are coming into the market now. From the issuer side, I would say they are seeing flexible capital within the ABS markets. Remember, the ABS markets are very similar to a mortgage-backed security, which I'm sure you covered on previous episodes of Channel 11 as well. But these are tranched out securitizations. So you can choose where you want to be involved in the capital structure, and therefore you can have different profiles in terms of interest rate exposure. But then you can also have different exposures to amount of credit risk you want to take. So it's very flexible capital for these issuers. They can issue into the market and get pretty good cost of capital because they're able to tranche out different levels of risk. Another reason people are coming into this market is there's been a huge amount of M&A activity over the last several years. And if you think about a lot of the M&A buyers, the buyers of these targets, they're buying companies, and these companies may have assets on balance sheet. Now, those assets on balance sheet may be able to fund some of the acquisition, or also may not be a part of the core competency of what the buyer wants to do with the company. So what they'll do is they'll essentially look to the ABS markets to monetize those assets. So that has really given some of the issuers the incentive to come into this market. Now, the buyers who are buying into this market are looking at the same thing. I mean, they're looking at different interest rate exposures they can get. They're looking at different credit quality they can get. And in many cases, a lot of these, like if we talk about renewable energy or transportation assets, those are pretty new. And as new assets hit the market, spreads are very wide. So it's pretty attractive for an investor to come in at that point in time.
And I think it's important for our viewers to know, like when we're talking about issuers, you could have a deal backed by like American Express credit cards.
Definitely.
Right? And so these are big corporate names that they can go finance themselves in the investment grade corporate bond market. Maybe some of them are in the high yield market. Maybe some of them issue in money markets too. But they're going to kind of like diversify their financing in this kind of ABS world. And American Express, Citi Card, Bank of America, those are kind of like your blue chip names. Who are some of like the newer issuers that are also kind of well known? Like there's been this growth in kind of this fintech space, but some of these companies, maybe some of the viewers have borrowed money from them, right?
Oh, absolutely. So I'll definitely get to that question. Your earlier question was just on the differences, and I never answered it, but I do have a slide on that. So the differences between a corporate bond, if an issuer went to the corporate market, versus an ABS type structure. And here it's laid out on the screen pretty simplistically. If you're a corporate borrower or you want to issue debt into the corporate market, it's very simple. You issue bonds into the market, the investor buys those bonds, essentially the liabilities of the company, and you're essentially facing the corporation. Now, they're not pledging anything to you. They're essentially telling you, I'm going to pay you back one day, right? Yeah. So you're unsecured, especially in the investment grade market within the corporate market. By definition, that is unsecured market. Now, with the ABS market, it's very different in that you're not facing the company. So if you look on the right here, we have the issuer facing, essentially selling the assets to an SPV. SPV is just a special purpose vehicle. Think of it as just like a container that the assets are going into. And then the investor is essentially investing in bonds issued by the SPV. So no longer are you facing the issuer or the company anymore, you are facing this SPV, which owns these assets. And therein lies the difference, because remember I mentioned that the corporation, you're unsecured, you're backed by the good faith of the company. With the SPV, you're essentially backed by those assets. So you're secured by an asset. And that has its pros and its cons. On the benefit side, clearly in a market like we're seeing today, there's a lot of discussions about growth and concerns about leverage at the holding company level. You don't necessarily have to worry about that with an ABS because you're structured to a specific asset. You already have your capital structure in place. There's no concern about adding more leverage or anything like that. So in that sense, it's very good. Another sense where it's really good is that in the case of a default or something like that, you have first lien to those assets. So you could liquidate those assets and you could recover that way.
They're bankruptcy remote, so whoever the issuer was could go under.
That's right.
And you're fine, you have the assets in the SPV and they can't touch it anymore.
That's right. So that's the big positive, but it can also be a negative. So I have a lot of discussions with corporate investors in the space, and they want to talk about the negatives. And look, let's be honest here. There are certain negatives. There's not a single structure that's perfect for everything. In the case of a bankruptcy type situation, for a corporation, they have many levers to pull. They can go into DIP financing, they can reorg, they can do many different things in order to, they can even issue more debt if they have the capability to kind of essentially get themselves out of that situation. Now with an ABS security, you have those assets in place. You can't do anything in terms of issuing more debt. You can't go into DIP financing and like that. What you have to do is essentially maximize the return of those assets. Worst case scenario, you're going to liquidate those assets and pay back SPV. So I would say the disadvantage for an asset-backed structure is that while you're secured, you may have less flexibility during a bankruptcy situation. I have one story I could tell you, or maybe two, here to kind of just illustrate how that could be the ABS structure could be beneficial. And we just came out of a very difficult time with COVID. And our desk on the ABS desk, we had never invested in rental cars before. And at that point in time, if you remember, business travel, leisure travel all stopped. No one was traveling anymore. Now, it's very easy to say now, like we talk about all the time on the desk, like used car prices are through the roof. It's so easy. Back then, it wasn't that easy.
Yeah, it wasn't as certain.
That's right. Like everyone said,
prices could go down.
Yeah, prices are going to go down. No one's going to drive anymore. Everyone's going to be at home. Like no one's going anywhere. Why would you want to own a car? So for us, we did a little outside of the box thinking. We actually contacted some of the auction houses that auction used cars, and we talked to the owners of the auction houses, asking them what they were seeing, and they were seeing cars being auctioned off, and the levels that they were seeing were pretty strong. So we put that through our analysis, and we said, hey, look, at the corporation level, they're going bankrupt, or they were talking about it. But for an ABS approach, we have access to these assets. These assets are holding up pretty well. These bonds are trading at a deep discount. Even if we liquidate all those assets, we're getting out whole.
Even if you liquidate them probably at a loss.
That's
too.
right.
Yeah.
That's right. Right. So we decided to go in, and that was a really good example of why an ABS structure worked when the corporate exposure at that time had a very precarious feel to it. So that was kind of an interesting thing that we saw with the ABS markets.
Yeah.
Yeah.
Another similar kind of story to that vein that I use with investors, because we used to invest in distressed mortgages during the global financial crisis, and one of the reasons that they became so distressed was the models pre-crisis thought there were going to be very low losses.
Sure.
So they would put very limited amounts of bonds below you, and those bonds need to take losses before you get hit and you get a AAA rating, right? Like subprime auto, I always ask people, do you think those bonds took a loss during the global financial crisis? And everybody's like, oh, of course, subprime auto. But miraculously, they didn't.
That's right.
Because the rating agencies looked at the loan and said, hey, this is a subprime borrower. Yep. They're probably a pretty bad borrower. They're going to default.
Yeah.
It's a used car. You're going to sell it, it's going to be a loss, right? And so they priced in kind of all these bad things into that capital structure. And I think that's one of the other benefits of just securitized products, and ABS as part of securitized products, is if you know the collateral is riskier, that can be priced in, so you can take risky collateral and make a really great bond out of it.
Sure.
Like these unsecured consumer loans coming from the fintech companies, a lot of times people are like, well, do these guys know what they're doing? What if the losses are higher than you expect? But in many instances, you can run really, really high losses if you're at the top of the capital structure, and it's super secure.
That's right. That's right. And you know what? You bring up a good point. And maybe this is another difference that we didn't talk about. With a corporate structure, when you're borrowing against a corporation, just for example, Amazon, initially they sold books. That's what they did. And if you bought one of their bonds, essentially you underwrote that business. This is what they're going to sell. Now, they have so many different lines of business now. They have media, they have data center, Amazon Web Service business, so forth and so on. And luckily, like all of those things are really working out well, and it's been additive to the company. But your thesis was underwriting it based on one thing, and it turned out to be something very different. And that is the difference also with an asset-backed or structured finance in general, is that when you underwrite something, that is what it is for the whole life of the deal. You don't need to get surprised that, hey, all of a sudden they're going into this business or going to that business. Like, you know what you're getting in day one, and you know what you have when the transaction essentially goes into maturity. Right? So I do think there's a lot of transparency there. A lot of, I guess, people who are like ill-informed maybe about the transparency of the sector. I would say in many ways, it's more transparent than a corporate structure.
So can we go back to the page that showed the different sectors of the ABS market? We talked about kind of just think about, if it's not a mortgage, it goes to the ABS market, right? And credit cards, auto loans, student loans, it's like basically any type of receivable you can collect and you can package it up into SPV and pass it on. So what are like, give us an example, like how is a renewable solar deal work? Like somebody comes in and they want to put solar panels on their house and they borrow money and they have to pay that back, right? Is that how it works?
It is. I mean, and this is the thing too. I mean, we put renewable up here as an example, but really what I see is a lot of infrastructure assets coming to the space. And you may ask yourself, like, infrastructure, how does that even fit into structured finance? Remember the basic framework of structured finance we just talked about. You have an asset, it generates cash flow, so you could securitize that cash flow. As long as you have this long-term cash flow stream that's, pretty transparent, you can securitize it. Now, infrastructure assets, including renewable energy in general, what they are doing is they're building this asset, and then they have contracts in place against the service that's providing. So instantly what you did is just create an asset with a long-term cash flow stream. So it's only natural to see infrastructure type assets flowing into the asset-backed space, and renewable energy is one of the biggest ones. It's one of the biggest growth areas within structured finance. And the way that works is, yes, exactly the way you explained. And this could be both on the residential side or the commercial side, meaning utility scale type solar. So for the residential side, what you'll do is, any of the listeners out there, maybe you already have it, but you'll contract and get rooftop solar in your home. You're essentially paying a fee to use that. And over time, there is a contract in place, and you're essentially paying down the assets that are sitting on your roof. The same thing happens with the utility. Utility will essentially contract and build a solar field or wind turbines, and they have long-term contracts in place with the utilities that were essentially off-taking that power. Mm-hmm. So you have that cash flow stream. Once you have that, it's I don't want to say it's pretty easy, but it's then feasible to put into a structured finance vehicle.
That company that's building the wind turbines, they don't want to sit and wait for those cash flows. They want to go build more wind turbines. So they're selling those ahead, and then they're taking the cash to go keep doing what they do best, right?
That's exactly right. And then you know what, you're saying a lot of points that are making me think. I'm going back to the other slide. You're right. They want to essentially recycle their cash flow because they're not sitting on infinite amounts of cash flow. If they can monetize that into the market and then go build a new project, it's the most lucrative for them. Now, there is an issue there. And one thing we talked about, and let's be honest, what is a negative? We talked about one of the negatives is having fewer levers in the case of bankruptcy. Yeah. That is mitigated with having direct first lien security in the asset. One other thing that's going on within a lot of the structured finance world, especially in ABS, is some of these M&A type activity, private equity type firms, they're essentially monetizing assets into the market. And if they essentially sell those assets off, what you need to have them have is alignment of interest or skin in the game. So they need to retain some amount of risk. And that is one thing that I would say is, I wouldn't necessarily call that a disadvantage, as something that you need to be mindful of, is as these types of projects come into place, whether it's renewable energy, whether it's transportation, even some of the fintech type issuers, you want to make sure that they're retaining some risk so that the forward operations of that asset are very smooth. And that's one thing that we underwrite pretty deeply.
Yeah, and they have to now because of regulation, right? Most issuers have to keep some skin in the game. Right?
They have to keep some skin in the game. Typically for us, we want them to hold even more than the minimum requirement.
Yeah, the minimum is 5% for everyone that's out there. Under Dodd-Frank, it's called risk retention. You have to hold 5%.
So in some of our transactions, we have them hold 25 up to 50% of the risk, and that we feel aligns our interests.
So the tech world has had a rough 2 quarters.
Tell me about it.
Has that spilled over into the bonds that they have sold, or because they're kind of remote from their business, is it still okay because you're just buying the cash flows, right?
Yeah, I mean, in some ways, yes. One thing let's just talk about real quick is just on the consumer and this kind of adoption into fintech. So on the slide here, what we're seeing is basically debt by generation. So this is broken out into millennials, baby boomers, Gen X, and the silent generation. And you can see that a lot of the older generation, and unfortunately, Ken, you and I fall probably kind of in that boat now, unfortunately, they are tapering off some of their leverage. Yeah. And they're not using as much. They're established. They have their home, so forth and so on. They don't require as much additional leverage. What you see here is the millennial. They are having significant uptake in leverage. But one interesting thing that they're doing is they're taking it in a different format. So this next slide here, what it shows is credit card issuance within the ABS world versus fintech type issuance. And the fintech is the lighter blue bar, the credit cards is the darker blue bar. And what you can see is that 2015, 16, 17, there was growth. And then it started declining. And it's been declining quite rapidly since then. And what you see picking up is fintech. Mm-hmm. And the reason for that, we think, is because there is a demographic shift. The millennials, they are a digitally native generation. They grew up with the internet. They want to do everything on their phone. Yeah. And they're not looking to walk into the bank, so forth and so on. So it's only natural you're starting to see that progression. And when you see that progression, it evolves a traditionally mundane process into something completely new. And that is really what we see as the huge opportunity with ABS. Like, markets are changing, the way people are financing is changing, and then the consumer behavior is changing, and that's leading to a lot of new asset classes coming into the space, which is very exciting because there are a huge amount of opportunities out there as these kind of new ideas show up.
And so, what are your kind of favorite exciting new things in ABS? Like, what's like top 3?
Yeah,
most exciting things?
I'll get right to that. I realized I told you about like the background for fintech. I didn't answer your question about fintech stocks really taking a nosedive recently. How are the bonds holding up? And I would say the bonds are holding up very well. And remember, the fintech stocks that are not doing so well, it's really predicated on their forward growth expectations. They grew extremely well during the COVID pandemic. And then as interest rates rise, as inflation takes hold, there is some expectation of less consumption. So if you have less consumption, those forward earnings probably will not be realized, or at least that's what the market is expecting right now. So the stock's going to fall pretty drastically. Again, remember, we're separate from that. We have pools of these loans.
Yep.
They're continuing to pay. Defaults and delinquencies are very, very, very low. Actually lower than our expectations when we underwrote these transactions. So those transactions are performing phenomenally well. So there is a bifurcation there, and it just shows you kind of the difference between investing more on the corporate side versus a securitized way of investing.
Yeah, so I mean, with the stocks tanking, I would think that the corporate high yield or bank loan debt that they have would probably be suffering.
It's widening out, yeah.
Whereas, our sectors in securitized have widened in compassion, but just the structures have held up, I feel.
You're right, they've widened. The one other thing is they're paying down quickly. So you don't have, I don't want to go into all these bond technicals, but in terms of the sensitivity to spreads widening, if your life is quite short, it's not going to be that sensitive. And that's what we enjoy. We have relatively short-lived assets. They're paying us down. So the spread movement hasn't been so impactful for us.
Yep, we talked about that a lot, is just the shorter spread duration of the securitized credit. Just even a broad basket, if you bought across all of securitized, you'll end up with a shorter spread duration than if you probably buy a basket of corporate credit.
Yeah,
right?
Definitely. Your other question. I'm catching up to the questions you
Top
asking.
three most interesting things.
So top 3, I would say, and this is not necessarily an order of our affinity to any sector. It's just really the 3 areas that we're really tracking the most. One of them is really around the consumer. The consumer behavior is changing so rapidly. And the way that the issuers are collecting data is real time now. In the past, if you had a credit card, you charge it up at the end of the month, you make that payment. The way it's working with the fintech space is they're almost providing a loan every time you buy something. So they have full transparency into what you're buying. They understand, your behavior. And like, we can go into a privacy thing. Let's not talk about that.
You mentioned something. We're going to have ads about credit cards on
our
Instagram
we probably
feed
will.
now.
But that gives them the ability to kind of rein in a borrower if things are getting out of hand. And time will tell if the performance on this new method of implementing leverage is better than the previous generation or method of doing it. But that data transparency is very, very strong. And that's something that we really buy into and we do think could be pretty attractive here. The one thing about the consumer too, it's relatively short-lived. So you don't need to take this projection, 10 years from now, what's going to happen, 5 years from now, what's going to happen. These loans are typically 1-2 year type loans. So if you have a reasonable estimate of how the economy will be in a year from now or how these borrowers will behave a year from now, you can make an assessment and get involved in the situations. And for that reason, we do have an affinity towards the consumer right now, especially with all the evolution in that space.
It's interesting you bring up the data being so valuable. My wife's relative was in from Asia, and I was, they run some retail businesses selling groceries and things like that, like almost like Costco out in Asia. But I was asking him what he thought about the Chinese government and what's going on with like Alibaba and like what happened to the CEO of Alibaba. Is he like alive? Was he hiding?
Yeah.
And I asked him like, why did all that go down? And his response was that they had gotten so big in banking that they had all the data about the consumer.
Yeah.
Because they were doing all the lending.
That's right.
And that's something like the government didn't feel comfortable with. Kind of seems like our government's kind of headed that way too a little bit, right? I mean,
yeah. I mean, look, this is a sensitive topic, and I don't know if we we want to cover it on this show, but yes, I mean that is. I mean, I think there's a lot of discussion around privacy rights, and some of these fintech type issuers, they're gathering a lot of data, right? And that data is very valuable. And in many ways, that data may be more valuable than kind of the lending returns.
Because you can see changes in consumer
That's right.
preference
That's right.
immediately.
And
right?
you can target consumers a certain way. And that data you could sell to other entities as well. So that data is very, very valuable. I mean, look, I'm not an expert with geopolitics and China, but my understanding with what was going on there is that, let's just put it this way, they really expected those quasi-SOE type entities to behave a certain way, and when you start moving out of the boundaries a little bit, that's when you have some trouble.
Okay, so consumer assets.
The other one is somewhat around what we're talking about now. It's just the digitization trends that are going on, and a lot of this is being financed through ABS market. Just for example, data warehouses, data centers, they're being financed within the ABS space. And we do think that's a huge area of growth because everything we just talked about right now, that data needs to be stored and accumulated somewhere. And data centers are the medium for that right now.
Yeah.
So anything around digitization, we're really digging deep on. And the last area is maybe a little bit more, I shouldn't say off the run, but it's this phenomenon of ESG. Everyone's talking about it now. In Europe, you've been to Europe, the investors are essentially demanding it. And I do feel that in the US, we are moving in that direction. We're not quite demanding it yet, but there's definitely those out there who would love to do well by doing good. And because of that phenomenon, I do think there's going to be a lot of push for these types of assets. And within the ABS space, you see it. You see the wind and the solar, but then you're seeing other types of things, traditional energy for that matter. You may say traditional energy is the furthest thing from ESG as possible, but what's happening is they're securitizing pools of essentially wells where they're operating as clean, if not cleaner than some of the large conglomerates out there. So I am seeing this push towards ESG, not only on the environmental side, really on all parts of that ESG type framework. And I do think that will be an area of opportunity because investors are demanding it. And I think that could actually cause spreads to come in some of the spaces.
I mean, even Fannie and Freddie have come out and Ginnie Mae, and they have affordable housing, lending programs to help people that may not be able to get into a traditional
That's right.
conforming loan. You can put less money down. They've got the program for the veterans and things like that. So there's a lot of parts of the structured market that can potentially fall into that ESG category.
Yeah,
right?
Definitely. I mean, I think we did have one slide on it. It's just showing the growth. This is not necessarily in ABS only. It's across all markets, and you could say all debt markets, I should say. But you can see how large the growth has been. So the structured finance world is catching up, and I think it's going to follow a similar trend.
So is there a way that the average investor can get access to some ABS opportunities out there?
Yeah. Well, I mean, I would say this is that, here at DoubleLine, we do implement it across many of our platforms, whether it's our total return, even our more opportunistic strategies hold this product as well. So I would say that's the best way to get it. I'm starting to see some dedicated strategies within the space, but I would say, for them to get involved, I would say the structured product platform would probably be the best way because you are seeing increasing allocations to that space as kind of this market evolves.
Yep. Okay. Well, thanks for coming in and talking about the ABS market. A lot of growth, a lot of opportunities, and we'll hope to have you back next time.
Yeah, definitely. Thanks for having me on.
Cool.